So good morning and welcome to this My Money Matters hosted webinar, APCs versus shared cost AVCs. What's the difference? My name is Ian Addison. I am one of the financial education coaches at My Money Matters, and I've worked in financial services for over 40 years. And prior to joining My Money Matters, I worked for Prudential for 7 years. Prudential being one of the main providers of AVCs in the local government pension scheme. During that time, I've assisted thousands of members like yourselves in retirement early and with more money. So I'm going to explain the difference between additional pension contributions and additional voluntary contributions, which are both designed to provide you more income for that key chapter of your life, your retirement. Please note this webinar is for educational purposes only. It doesn't constitute financial advice in any way. Any information that I run through is based on our current understanding of taxation, legislation, and scheme rules. Levels basis relief from taxation are subject to change and also treated on an individual basis. And in respect of the investment funds from the providers, remember that they can go down as well as up. And past performance of those funds should be seen as an indicator of how they may perform in the future. Now, this webinar may be recorded for training and compliance purposes, but that also means that if there's anything you want to revisit from the webinar, you can always download a recording of the webinar after it ends. As we go through this morning's webinar, if you want to ask any questions, you can do so by making use of the Q&A feature that you'll see at the top right of your screen. Please try and keep any questions that you have in relation to the content that we go through, and also try to avoid sharing any personal information. What I'll do at the end of the webinar is run through any questions that you have. Now, this is a relatively short webinar, so if you do have anything that you want clarified, be sure to ask that question as soon as it comes in your head. And if you don't get round to answering that question, there are always means of contacting us after the webinar anyway. Now, in addition to the webinars regarding retirement, we do other webinars as well as we expand into other financial knowledge and helping you understand all things in relation to your financial life. So we do webinars on debt and money management, savings investment, estate planning, insurance and protection, as I said, a lot of other ones regarding retirement planning as well. So if you feel free to avail yourself on any of the additional webinars which may help your understanding of those matters. So saving additional money for your retirement, it's a really important thing that everyone has to sort of take into account and factor, because a lot of people want to retire before their normal pension age, particularly as it only increases. But in order to ensure that you're able to retire early, you need to have enough money because your local government pension will be reduced if you take it before your state pension age. So what options do you have? Well, one of the options you have is additional pension contributions, where effectively you are buying more local government pension. Now, some people like that security and knowledge that they know exactly what they're going to be receiving when they retire. So that guaranteed income gives that peace of mind that you know what you're going to be receiving when that time comes. As you may well be aware, the local government pension scheme is paid for life. It doesn't run out after 15, 20 years. It carries on until the day you die. So that's what makes it a really valuable pension that is really going to make a difference to your post-career life. Also, more reassuring, particularly at a time when the cost of living is so much in the news, is that pension increases in line with inflation. So it's measured against a consumer price index. So effectively meaning that the external factors such as inflation will not have a diminishing impact on the true value of that pension. Now, it's also worth noting that additional pension contribution income does cease at death, and also that if you were unfortunate to pass away before retirement, any additional pension that you purchase would actually die with you, would not go to your nominated beneficiary. And I'm sure we obviously the hope is that that wouldn't happen, but it is an important thing to bear in mind that if your retirement is maybe some way off, then that is a key consideration to factor in. They will get tax relief on your contributions. You have two ways of purchasing additional pension contributions. You can purchase it by way of a lump sum. Any tax relief you'll then have to claim back via HMRC, or you can make the purchase of that and make repayments through your salary each month over a set period of time. Now, the cost of the additional pension contribution is going to depend on a number of factors. It's going to depend on your age, your sex, and the repayment period. Effectively, the shorter the period between now and retirement, the higher those repayments will be. Generally, people tend to find it is quite an expensive way of providing additional provisions for your retirement. Now, you can go onto your main LGPS members website and get an indication of what that cost may be. So if you're in England and Wales, just go onto the LGPS members website there. Or if you're in Scotland, again, go onto your members website and you'll find that calculator to determine what the cost would be for buying that additional pension. Generally, you would need to live for over 15 years into retirement to effectively recoup the money that you pay into additional pension contributions. Not to say that you wouldn't, but again, none of us necessarily know that. So again, that's why people tend to find it a little bit expensive as a way of boosting their retirement income. Now, in terms of the other option, shared cost AVC, that based on a basic rate taxpayer of 20% could give you an immediate return of nearly 39% in the shared cost AVC. And the way it does that is because whatever you pay into the shared cost AVC, not only do you get tax relief, but you also get national insurance savings as well. So effectively a double tax break on the contributions that you pay into the shared cost AVC. So it's an extremely tax efficient way of building up an additional pot of money that runs alongside your local government pension. And what you do with that money is entirely down to you. Now, you could use that money to then purchase more additional local government pension or buy an annuity with it, but ultimately you can go traveling the world, buy yourself a new car, whatever you want to do. So it's not automatically giving you extra pension. It's building up a pot of money in a tax efficient way that you can take back tax-free up to a certain limit if you take it at the same time as you take your local government pension. So that's what makes it really unique insofar it gives you that option. So it's worth noting the local government pension scheme is the only public sector pension scheme that allows you to take the AVC back tax-free. As I said, there are some caveats to that. One being that you take it at the same time as you take your local government pension. And there is a limit on how much you can take, which ultimately is going to be determined by the size of your pension. But if you were in the NHS, if you were a member of a teacher's pension scheme, you could have an AVC, but you would never have an option to take it all back tax-free. So that's what makes it a really great employee benefit that you have. The other thing to bear in mind is you have complete flexibility over the contributions that you pay into it. So if your financial circumstances change, you can adjust the contributions accordingly, which is unlike additional pension contributions, because if you repay the purchase of that additional pension through your salary each month over a period of time, maybe 5 years or whatever it may be, that's a fixed amount that you're going to have to pay for that additional pension. If for any reason you're unable to make that contribution because your financial circumstances change, effectively the contract will be cancelled. You'd have just accrued what you built up to that point. And if you wanted to start the process again, then obviously that would be what you would have to do. So how does the shared cost AVC work? Well, the only way that you can pay into it is through your salary each month. You have no other means of doing so. So you can't do a bank transfer, you can't write a check, it has to go through your salary. So every payday, effectively paying into a shared cost AVC, is an opportunity not only to make those tax and national insurance savings, but also build up that pot of money that's going to make a difference to your retirement. As I mentioned, you have that flexibility and peace of mind to change those contributions anytime, anything from £2 a month, which is the minimum contribution, up to whatever figure keeps your salary above the national living wage. And you can change that from month to month. So if your washing machine packs up one weekend, you need to go down to Coles to get a new one. You can drop your AVC contributions down to as little as £2 a month, go and get your new washing machine and pick them up later. It really is that flexible. Now, the money that you pay into the shared cost AVC is then invested. So the idea, as well as getting that tax and national insurance saving every month, you also get some investment growth as well. So the idea of it being invested is that the pot doesn't stagnate. So it doesn't diminish in terms of the buying power of that money over time. Now, the company responsible for investing your APC money will depend on your employer. Your pension fund would have chosen that company. The vast majority of it will be Prudential, maybe Standard Life. It may be Legal and General or Clerical and Medical. Now, all of those companies will effectively have a range of funds. So you are in complete control in terms of where you want that money invested. So you can choose to take as much or as little risk in terms of those investment funds. They will have different risk levels. So the higher the risk, the more potential to grow your money, but obviously the more volatile those funds may be. You can split it across different funds at different risk levels. You can change those at any time. You may also have what is known as a default investment option, one chosen by the trustees of your pension fund for people who maybe don't want to make an active fund choice or struggle to do so. It's not a recommendation in any way, but it is there for that purpose. If your retirement is somewhere from a distance, there's normally lifestyle options as well, which are aimed at long-term growth, where the risk of a fund automatically switches as you approach retirement. So ultimately, there should be something which suits everybody's own attitude towards risk. That control and flexibility continues at the point of retirement. So as I said, you could use the money that you build up in the AVC to purchase more additional income in retirement by way of more local government pension or an annuity, for example. However, you have this unique option in public sector pensions that allows you to take the AVC tax-free up to a certain amount and do what you like with that money, whether that's buying a new car, traveling around the world, it's entirely down to you. Now, to look at the potential savings that the shared cost AVC can give you, you can go on to the My Money Matters calculator on the website, and that is a really useful tool to give you an idea of the potential this employee benefit offers you. So all you basically do is put your salary in, how much you're thinking of paying in, and when you're looking to return, it will do two things for you. It will tell you the cost to you from your take-home pay for that contribution, and also what you could potentially build up between now and retirement. Very easy to use, but also quite powerful in seeing the potential that this is available for you. So just to summarize in terms of the difference between additional pension contributions and the shared cost AVC, additional pension contributions are providing extra index-linked guaranteed pension within the local government pension scheme, effectively enhancing what you're due to receive when you retire. The shared cost AVC is a separate pot of money you're saving into and invest into the fund or funds that you decide suit your attitude towards risk. You get tax savings on the additional pension contributions. With the shared cost AVCs, you'll receive tax savings and also national insurance savings. And again, local government pension scheme is the only public sector pension scheme that allows you to save in this way. So the additional pension contributions is a contractual agreement. As I said, you don't have that flexibility to change the amounts. A shared cost AVC, you have that peace of mind and flexibility if your circumstances change during the time you're paying into it and also when you come to access it. So if you need any further support after today, how do you avail yourself of that? Well, quite simply, you can email us at support@mymoneymatters.co.uk. There is also a live chat facility on the website as well. So if there's something you're not quite sure about or just need clarification, or if you're completing the application form and get stuck, use that live chat facility. Similarly, during working hours, you can pick up the phone and dial the number shown and speak to our friendly customer services team. Knowledge Hub, as I've just mentioned, contains that calculator. So a really great way of seeing the potential that you have available to you. Also appreciate sometimes you might want to discuss this with your partner or other half, and let's be honest, pensions, maybe not the most exciting topic of conversation at the dinner table or even the easiest to understand. So there are some short explaining videos on the Knowledge Hub as well that you can blitz watch Netflix style, cement your own understanding and get that message across to somebody else. If you have queries about shared cost AVC, so something you're not quite sure about, what's the impact on this? Will this affect that? You can go onto the website. There is a link to FAQs, frequently asked questions, which if you click on the link will download a PDF document, which will be bespoke to your individual employer. And that will pretty much cover any question that anybody's ever asked about the shared cost AVC. So, as I say, make use of those resources to enhance your own knowledge about this. I can't see any questions to come through, which is absolutely fine. But if there are anything, by all means, get in touch with us and we will endeavour to answer those for you. So as I said at the start, retirement is a really key stage of your life, one that you may have worked 40 years, not necessarily all in local government, to reach. So when you reach that time, you want to make sure that it's as fulfilling, as enjoyable as possible, that all those days and years working 9 to 5, maybe longer, having good days, having bad days, all add up to enjoyable retirement. But effectively, there's going to be two things which determine how fulfilling your retirement is, whatever age you retire. One is your health, which we can't always predict or control. And the other, quite simply, is how much money you have for that time. And as I said, you do have options to enhance that any way you like. But in order to make the most of those opportunities, you have to embrace them. Thanks very much for listening to me today. I hope you have the rest of a pleasant Friday and a fantastic weekend.